Hello, everyone, and welcome to the NASDAQ Dorsey Wright podcast on this Monday, January 11th of 2021. My name is Will Gibson, and I'm joined by Sara Maley this week. And Sara, starting trading this week, or rather this morning, it looked like we were going to get a bit of a pullback. Later in the day, markets seem to have come back around a little bit. Dow positive at the moment, up about 20 basis points. Small caps also performing well on the day. And then the more tech-focused NASDAQ is still down as of trading right now. But Sara, starting with the Dow Jones, we had some notable action last week.
Yeah, so the Dow Jones Industrial Average last week, we saw hit new all-time highs last Thursday when it surpassed the 31,000 kind of milestone mark that we've talked about before, just these 1,000-point increments that we've just seen the Dow breakthrough over the past few years. On the screen right now, if you're following along, we do have the 100-point chart of the Dow Jones pulled up. And you can see that after printing that all-time high at 31,100. On Friday, we did see the chart pull back slightly with a three-box reversal to 30,800. Another thing that I will note here is the fact that last week we also saw the day before the 31,000 mark. So on Wednesday, we saw this chart break a double top at 30,700, and that followed a quadruple top. So then our book, that is considered a bullish catapult pattern after you kind of have a large base with two consecutive breakouts. So that's a positive there. We are close to seeing this chart potentially reverse back up into X's. So that's something that we will be watching closely. But back to that 31,000 mark, we do track the amount of time that it's taken for the Dow to go from one kind of milestone, if you will, from the next. And the index just crossed above 30,000 on November 24th. So it took 44 days for the Dow to gain 3.33%. And going back just to through the history of the Dow, this marks the sixth shortest 1,000-point run we have seen. And actually was the shortest we've seen since January 17th of 2018. And so that's when we saw the index hit 25,000, moved above 26,000. And that only took 13 days, 13. So that was extremely fast, the fastest on record. And if you look on average, every 1,000-point move is about 584 days going back all the way in the Dow's history. But if we just look at the 20,000 to 30,000 range from January of 17 through now, that average is 126 days. So we are seeing that average kind of break down. But we saw the Dow hit a new all-time high. We saw the S&P 500 hit a new all-time high last week. And overall, U.S. equities remain number one. We have seen in our Dolly ranking, so U.S. equities ranked number one there with 329 buy signals in its favor. Right below it, we see international equities, and over the last week alone, we've seen international equities pick up 22 signals, which is pretty significant. We have seen some of that shift, the strength shift around, which we'll talk about. But in terms of U.S. equities itself, drilling down into that subsector level, technology still remains king there with 203 signals in its favor, trailed by consumer cyclical, which we've talked about over the past few months. That those have kind of been neck and neck there. But that third spot, we saw basic materials this past week move above industrials, more just kind of playing that reopening trade. So we will continue to watch that. But again, technology number one with consumer cyclical 2 and basic materials 3. And Will, I know that you saw some other things that you wanted to talk about.
Yeah, Sara, that's good stuff. And I mean, to reiterate what you were saying, it seems like a very risk-on appetite right now from the market. You have your two major equity classes demonstrating price leadership, as we're measuring here by Dolly. Domestic equities, you said 1, international 2, and again, a lot of tailwinds from international as of late. A third asset class ranked is actually commodities right now. And I do want to park there for just a moment and kind of reiterating the risk-on approach that we've seen from the market and some of those reopening trades or reopening speculations manifesting in investment as of late. That commodities group sitting 3. So that's again signifying a bit of risk on appetite within that asset class as well. And then you've also seen oil and base metals participate as of late. And with that, you see energy actually ranked number 1 in that commodities subsector view, followed by your industrial metals and then precious metals behind that. So again, very much of a risk on appetite there, finding commodities that are generally used in production of materials or anything that would signal economic activity being on the uptick. We have seen those in demand as of late. So that's something to keep an eye on. For the precious metals group, we do want to note that gold kind of continues to remain in that cooled off posture, but that's something to keep a close eye on later on in the year. So make sure to keep a watch there. Apart from the commodities kind of general risk on sentiment, I would also add, and we've talked about this before, Sarah, you and I and many other people on our team, is that the increased presence of smaller size leadership in the equity space in particular, seen here in Dolly, you can see small growth and mid growth both holding those number 1 and 2 size and style rankings. If you go on the asset class group scores page, also kind of the macro asset allocator guidance type of tool, you're going to see a very similar ranking, also signifying strength for smaller sizes. So I think that's an important trend to take note of. That's something that we've been noting for the past couple of months, whether it's through models, whether it's through kind of macro rankings, as we're showing here if you're following along. So that's a trend to note. Small mids demonstrating some leadership. Large is not necessarily weak, but perhaps we are seeing a bit of a tide shift or continuing to shift in that regard. Also on the platform, if you want to get a little bit more granular, apart from just the macro asset class rankings, Sarah was mentioning how we can see certain groups trending as of late with specific relative strength buy signal gains. So right now we're on the history view of the Dolly page, and you can see here that domestic equities have by and large maintained a healthy leadership amount of buy signals, entrenching them at 1 for now, and international doing the same, as well as commodities picking up as of late. And then we also see fixed income kind of tailing off there. So this is a way to see that when we're getting new buy signals from asset classes, where are they most likely coming from or what's giving them up. And we can do this by broad asset class. We can do it by size and style, sectors, as we talked about a bit of those moves as well. So I would also suggest taking a look here, just to be a bit more versed in saying, if this group is leading, maybe why is it leading and where is it coming from? But so Sarah, maybe going maybe a step further here, just from some macro observations that we wanted to reiterate. We've also seen on a more sub granular, minuscule level some of the indicators that we've been watching lately. And one kind of tangent remark before we talk explicitly about the indicators is a recent study that we did on the high lows, or excuse me, not high lows, but number of stocks in the New York Stock Exchange hitting new 52-week highs or hitting new 52-week lows. In the case of 52-week lows, last Friday, so January 8th, we kind of had a monumental occurrence where there were 0 stocks in the New York Stock Exchange that hit a new 52-week low on Friday. And that's very rare. It's a sign of breadth. It's a sign of increased and maintained participation to the upside. We've been putting out stuff in the past few weeks and months, for that matter, with similar indicators, and when they're kind of pushing to these breadth levels, historically has been very positive for the market on a longer dated forward basis. But for when we've seen 0 stocks hit new 52-week lows on the New York Stock Exchange, we've seen it 10 times really in the past 30 years. And this is excluding clustering events. But point being is that, like the other breadth thrust that we've seen, it's been very positive for the market going forward. And Sarah, another indicator that we know is popular and worth mentioning is the bullish percent for the New York Stock Exchange as well, also advancing.
Yeah, so today, I will say before today's action, we saw the bullish percent for the New York Stock Exchange sit at 74% in X's. And for those who are unaware, the bullish percent measures the percent of stocks within the New York Stock Exchange universe, or whatever given universe, but for this particular BPNYSE, it is going to be the New York Stock Exchange. And we're just looking at the percentage of stocks within that universe that are on point and figure buy signals. So telling us that demand is in control. So before Monday's action, we saw that chart sit at 74%. And then it looks like, just looking at today's intraday action, which you can find through the security selection tool menu, and then intraday reports, and then from there you can drill down into the individual bullish percents. It looks like that intraday calculation is sitting at 76.30, and these charts will not be they're not calculated officially until after the market is closed, and we're able to look at all of the kind of like end of day data once we have everything processed. But it looks like as of now that chart should add another X after this evening's update at 76, telling us that 76% of stocks are trading on a point and figure buy signal. And then I also took a look at the positive trend indicator for the New York Stock Exchange. That particular indicator is above 50, which is what we like to see, telling us that at least half of the universe is trading in an overall positive trend. So while the BP is looking at bullish percent, the percent of stocks on a bullish on a point and figure buy signal, the positive trend indicator is looking at the percent that are trading in an overall positive trend. And this is the highest level we've seen, it looks like, going back to 2012. And this particular indicator is sitting at 72 at current levels. So overall, equities we've still just seen strengthen, and we'll bring any additional changes to your attention. But one change that we did want to announce this week is, unfortunately, as of January 13th, we will no longer be supporting the line above State Street ETF models, with the exception of the State Street Fixed Income model. So the State Street Fixed Income model follows the same underlying strategy as the Spider Dorsey Wright Fixed Income Allocation ETF, and that is symbol DWFI. So because that product will still be out there, we are still going to support the model version, if you will, and that will still remain on the site. The State Street Sector Model, the State Street Targeted Sector Rotation Model, and the State Street Global Rotation Models, so that's S Street, SS Target Sector, and SS World, those will no longer be live on the site. We have been publishing the rules and transparency around being able to run those models on your own, especially made it a lot easier now with the new the custom modeler tool, which you could use for the SS World and SS Target Sector. The State Street Sector Rotation Model uses a RS versus benchmark methodology, which can be replicated. So if you have any questions on that, we definitely can help you out there. But we will be sending an email out to all users that have alerts set for these various models, just to let you know. And again, we have been providing over the past few weeks the rules and things around the different State Street ETF models that you can replicate yourself if you wish. So unfortunately, that's happened sometimes. So we just wanted to make users aware. But again, that State Street Fixed Income model will remain up on the site.
Yeah, Sarah, thanks for that update. And maybe just rounding out some concluding remarks, I think it's going to remain noisy, perhaps, as it has with the markets or anything really related to the markets for that matter. So point and figure, the kind of relative strength objective rule set that we implore, I think can be very useful right now, kind of the soulless barometer, if you will. Remember those charts when you're having some days where we start down, then we close up on the day. Keep in mind they're not using closing prices, and they're only going to be plotting action when the chart kind of reaches those material levels with the point scale on the right hand side. So inevitably by themselves designed to sift out market noise and only plot that material movement. So in addition to that, we're going to try to note that material movement as well, whether it's in podcasts, whether it's in update videos, weekly reports, all of that. We're going to do our best to keep that coming your direction. But apart from that, Sarah, that's all I had. Thanks for joining this week, and thank you all for listening in. And we will look forward to talking to you again in the future.